Imagine analyzing 46,000 days of market data.
Yeah, that is just a staggering amount of information to process.
Right. I mean, you're mapping out decades of price action across equities, futures, currencies, and you are stripping away all the noise, the talking heads on financial television, the gut feelings. You are looking for one single, undeniable mathematical truth.
And you actually find it.
Exactly.
Yeah.
You find out that the first 15 minutes of the trading day aren't random at all. In fact, more often than not, they actively dictate the absolute highest or lowest price of the entire session. So welcome to the deep dive.
Glad to be here for this one.
If you are prepping for the trading day, trying to cut through the noise of complex indicators, or you're simply a learner looking for a quantifiable statistical edge in the markets, you are in the exact right place. We're dissecting the opening range breakout strategy today, commonly known as the ORB.
And we are not just talking about the theoretical, those clean chart versions of this strategy you might see touted on social media. We are digging into the gritty, mechanical reality of the 9:30 a.m. Eastern bell.
Yeah, we pulled from a massive stack of source material today. We have detailed quantitative studies, algorithmic backtesting data, and some really advanced trading psychology frameworks.
Because the goal here is to separate the myth of the easy morning profit from the actual mathematically sound reality of how institutional order flow dictates the opening range.
Right. So we're going to break down the origins of the strategy, the exact criteria required to even consider taking an ORB trade, the mechanics of drawing the range, and those heavily debated risk-reward ratios that keep you from, blowing up your account.
Which is the most important part, honestly.
Absolutely. But before we get into the step-by-step execution, we have to talk about that 46,000-day data set. Because the ORB isn't some fleeting TikTok trend. The sources trace the underlying philosophy all the way back to the 1960s.
Yeah, to a legendary trader named Arthur Merrill.
Right, Merrill. He was applying these exact principles to the Dow Jones Industrial Average long before decimalization, before high-frequency trading algorithms, back when quotes were still coming off physical ticker tape.
The longevity of the strategy is arguably its most compelling feature. I mean, when you think about it, the markets have fundamentally transformed since Merrill's era. We have global connectivity, algorithmic front-running, zero-day options dictating intraday volatility.
It's a completely different beast now.
Exactly. Yet the foundational premise that the opening print establishes a critical boundary that has survived. And that brings us to the Grimes study you mentioned at the top. This is where the historical anecdote becomes a quantifiable edge.
Because Adam Grimes didn't just look at a few cherry-picked tech stocks during a massive bull run. He analyzed 46,000 individual daily bars across a massive spectrum of assets.
He was plotting the opening price of each bar as a percentage of the entire daily range, trying to see where that 9:30 a.m. print sat in relation to the ultimate high and low of the day.
And the data completely contradicts the standard assumption, right? The assumption that the market open is just a chaotic coin toss. The opening price heavily clustered near the absolute extremes of the day's entire range.
It is a structural anomaly. The data proves that every price print throughout the day does not carry the same weight. That opening print is disproportionately significant.
Right, but where the Grimes study gets incredibly actionable is when he filtered that 46,000 bar data set for what he classified as 2 sigma days, specifically in the E-mini S&P 500 futures.
Yeah, let's unpack the mechanics of a 2 sigma day, because the sources throw that term around a lot, but it's crucial to understand the math behind it.
So if we think about standard deviation, which is just the measure of how much price variation exists from the mean a normal trading day, falls within one standard deviation. That is just the baseline hum of the market.
Right. Buyers and sellers are in relative agreement about value.
It's exactly. But a 2 sigma day means the price action has breached 2 standard deviations from the mean. Statistically, roughly 95% of all data points in a normal distribution fall within 2 standard deviations.
So when the market breaks past that, we are no longer in a normal distribution at all.
No, we are in an explosive, high volatility trend day.
Exactly. A 2 sigma day is a structural break. It indicates an aggressive, one-sided shift in market sentiment. And Grimes found that on these specific, highly volatile days, the opening price being the absolute high or low of the day wasn't just a slight tendency.
It was a massive statistical probability.
Right, a dominant probability. The market opens, immediately rejects one direction, and then spends the rest of the session aggressively moving away from that opening print.
The mechanism driving, this is what I always picture as a massive dam breaking. Think about the mechanics of overnight liquidity. From the 4 p.m. close to the 9:30 a.m. open, the dam is holding back an immense volume of information.
Oh, yeah. You have earnings reports dropping after hours. You have geopolitical events occurring in the Asian and European sessions while we sleep.
Right, and you have macroeconomic data like CPI or non-farm payrolls releasing at 8:30 a.m. You have retail traders queuing up market orders on their broker apps at 2 a.m. All of that is water just building up behind the concrete.
And at exactly 9:30 a.m., the floodgates open. The dam doesn't just leak. It completely gives way.
The market is forced to instantly price in all of that accumulated asymmetrical information. That certain influx of order flow is what creates the violent volatility of those first few minutes.
The market is violently searching for a new equilibrium, right? A new fair value based on everything that happened while the physical exchange was closed.
And the opening range is simply the visual footprint of that search for equilibrium. The market makers and algorithms are testing liquidity, pushing the price up to see where the sellers are hiding, then slamming it down to see where the buyers step in.
That initial violent discovery process forms a high boundary and a low boundary. That is your range.
So the core thesis of the ORB is waiting for that initial flood to establish the borders of the battlefield, and then positioning yourself when one side clearly wins the territory.
However, the sources are incredibly explicit on this next point. Understanding the statistical significance of the open is merely the prerequisite.
Right, it's not enough on its own.
Not at all. The trap that destroys most retail traders is attempting to turn the ORB into what the literature calls a strategy in a box. You cannot blindly draw lines on the first 15 minutes of any random asset and expect to find an edge.
If the underlying context of the market doesn't support a directional move, that opening range isn't a launch pad, it's a cage.
We have to talk about context, specifically asset selection.
Yeah, because I've seen this exact scenario play out. A trader wakes up, decides they want to trade the ORB, and they just pull up a mega cap tech stock like Google, simply because it has tight spreads and high liquidity.
Right, which makes sense on the surface.
Yeah, but then they draw their 15-minute range, the price breaks out, they buy, and then the stock just chops sideways for the next 4 hours, slowly bleeding out their premium.
The mechanical failure there is a lack of independent volume. On a day with no specific catalyst, a stock like Google is largely going to be subjected to the exactly. A stock in play has completely decoupled from the broader market index because it has a compelling reason to reprice. It's marching to its own algorithmic drumbeat.
That catalyst is usually an earnings gap. Like a company reports a massive revenue beat after hours, or conversely, slashes their forward guidance.
Or it could be an FDA trial result for a biotech firm, a surprise SEC filing regarding an acquisition, or a prominent short seller report dropping pre-market.
The catalyst is the spark, but the RVOL is the oxygen. If you have a catalyst but the pre-market volume is dead, the market is telling you that institutional money just doesn't care about the news.
Which is a critical filter. The sources emphasize a golden rule here. If you were scanning the market at 9 a.m., you see a stock gapping up 5% on heavy volume, but you cannot identify the fundamental reason why it is moving.
Like if there's no news, no filings, no sector sympathy.
Right, then you walk away. Trading a high-volume gap without a known catalyst is trading against hidden institutional flow. You might be buying the exact moment a hedge fund is executing a massive block sale to liquidate a position.
If you don't know the why, you cannot predict the how.
Exactly.
Okay, so let's say we've run our pre-market scans. We found a stock with a massive earnings surprise, heavily decoupled from the S&P, trading at 300% of its normal relative volume. We have our stock in play.
But we still aren't ready to draw the range. We have to establish a directional bias.
Well, we have to know which side of the range we are actually interested in trading, and the sources bring up moving averages to establish this bias, specifically the 50 and 200 EMAs.
I actually want to challenge the source material on this specific point because applying standard moving average theory to a highly volatile intraday ORB setup can be incredibly dangerous if misapplied.
Oh, really? How so?
Well, the sources detail the classic golden cross where the 50 EMA crosses above the 200 EMA as a signal to only take long breakouts, and conversely, the death cross as a mandate to only take short breakdowns.
Right. The idea is you don't want to short a stock that is in a macro uptrend, and you don't want to buy a breakout on a stock that is fundamentally in a bear market. You want the wind at your back.
In theory, yes. But time frame alignment is everything here. A daily chart, Golden Cross, is a lagging indicator of macro sentiment over the last several months.
Right, it's historical.
Exactly. So if a company just announced a massive accounting fraud at 8 a.m. and the stock is gapping down 40% in the pre-market, that 200-day EMA is mathematically irrelevant to the 9:30 a.m. price action.
That makes total sense. The intraday algorithms aren't looking at a multi-month moving average when the fundamental valuation of the company has literally halved overnight.
That's a vital distinction. So the bias can't just be a blind reliance on higher time frame crosses. The bias has to be contextual to the catalyst and the pre-market price action.
So if the stock is gapping up heavily above the previous day's high on an earnings beat, your localized intraday bias is intensely bullish. You are looking for the opening range to consolidate that gap, and then you are looking to buy the breakout above the high to catch the momentum continuation.
And if it breaks the low of the range?
You don't automatically short it because you'd be fighting the massive institutional buying pressure that caused the gap in the first place. You just ignore the trade entirely.
Precisely. You use the pre-market structure and the catalyst to dictate your bias, and the ORB simply provides the mechanical trigger. So assuming we have our stock in play and our directional bias locked in, we have to look at the actual blueprint of the strategy.
How are we defining the boundaries of this battlefield?
Right. The sources outline two distinct methods for defining the range, and they really represent two different philosophies of market mechanics.
The first is what they call the two-candle approach. You take the high and low of the very last candle of the previous trading day, say the 3:55 p.m. to 4 p.m. candle. Then you take the high and low of the very first candle of the current trading day.
The total distance between the absolute peak and the absolute trough of those two specific candles combined forms your opening range.
The mechanical logic behind that approach is fascinating because it attempts to bridge the overnight gap. The last candle of yesterday represents the final agreed-upon value before the market closed and the news hit.
And the first candle of today represents the immediate panicked repricing. By combining them, you are creating a range that encompasses the entire overnight shift in sentiment.
But the second method is far more prevalent in the modern tape, and it's what most traders visualize when they hear ORB. You select a localized time frame the first 5, 15, or 30 minutes of the day.
You let the 9:30 bell ring and you do absolutely nothing.
Right. You let the market through its tantrum. Once that specific time block concludes, you mark the absolute high of that period and the absolute low. That is your box.
And we need to dissect what is happening inside that box because the sources universally refer to the space between the high and low boundaries as the chop zone.
The chop zone. I love that term.
It's very accurate.
Yeah.
But it's not just a dead zone where nothing happens. Mechanically, the chop zone is a meat grinder of algorithmic warfare.
You have mean reversion bots aggressively buying the bottom of that newly established 15-minute range, anticipating a bounce.
Simultaneously, you have momentum bots aggressively selling the top of the range, anticipating a rejection. The price is oscillating violently between these hidden institutional orders.
Though if you take a trade inside the chop zone, you aren't trading a setup. You are volunteering to be liquidity for those algorithms. You are getting chopped to pieces by the spread and the rapid directional shifts.
The entire discipline of the ORB is waiting for one of those institutional sides to exhaust their capital. You are waiting for the buying pressure to completely overwhelm the sell orders at the top boundary, forcing the price into clear air.
Which brings us to the execution phase. And this is where the theoretical elegance of the ORB collides with the brutal reality of live market execution. Identifying the breakout is easy in hindsight on a static chart.
Oh, of course. But in real time, the tape is designed to deceive you.
The sources highlight a massive discrepancy between amateur execution and professional execution here. The amateur stares at the high boundary of the range, and the microsecond the price ticks 1 cent above that line, they smash the market buy button, terrified of missing the move.
And that impulsive click is exactly how you get trapped in a false breakout, the fake out.
Right. The price pokes its head above the line. It triggers all the retail buy stop orders resting just above the high, creating a tiny synthetic burst of momentum.
But there's no real institutional backing. The smart money uses that synthetic burst of retail buying as liquidity to offload their own short positions.
The moment that retail demand is absorbed, the price violently reverses, collapses back into the chop zone, and stops everyone out. It's a localized bull trap.
To avoid that trap, the masterclass sources advocate for a completely different execution model. You don't buy the initial break, you buy the confirmation, and specifically the retest.
We need to walk through some granular tick-by-tick examples from the source material to illustrate the mechanics of this, because the nuance is entirely in the tape reading. Let's pull up the Apple audio walkthrough from the sources.
Apple is a great example for this.
We are looking at a 15-minute chart. The broader market is strong, Apple has a catalyst, so our bias is decidedly bullish. The 9:30 bell rings. From 9:30 to 9:45, Apple pushes up to $175.50, pulls back, and establishes a low at $174 flat.
So we draw our horizontal lines at those two extremes. The chop zone is defined. We are now in a waiting game.
And as we watch the 15-minute candles develop, the price pushes back up toward that 175.50 ceiling. The amateurs getting their finger ready on the trigger, the price ticks to 175.55. It has technically broken the range.
But the professional is looking at the anatomy of the candlestick and the volume profile. We don't want to see a long wick poking through the line, indicating that sellers immediately rejected the higher prices.
We require a full body, close outside the range. The actual meat of the candle must close definitively above resistance.
And crucially, we drop our eyes to the volume bars at the bottom of the chart. If the price closes above the range, but the volume is lighter than the previous three candles, it's an incredibly weak signal.
It means the price drifted higher on a lack of selling, rather than being driven higher by aggressive buying. We want to see a massive, anomalous volume spike accompanying that breakout candle.
That volume spike is the footprint of institutional size stepping into the market to support the new price level.
But even with a full-body, close and expanding volume, the conservative execution model dictates further patience. We want to see the market validate the new paradigm. We wait for the price to pull back down to the exact line it just broke out of, that 175.50 level.
This is the foundational concept of technical analysis, right? Previous resistance turning into new support.
When the price pulls back to that line, it's a test of the buyer's conviction. If 175.50 was truly the ceiling of the chop zone, the buyers who missed the initial breakout should be eagerly waiting to bid the stock up the moment it returns to that level.
When you see the price hit that line and immediately bounce, forming a long lower wick, that is the retest.
That bounce is your high probability entry signal. You are entering with the confirmed momentum rather than guessing the initial break.
The sources provide another excellent example on the S&P 500 E-mini futures, the ES, using a 30-minute opening range.
Futures markets are wild. They trade with intense precision because they are heavily driven by algorithmic levels.
Yeah, in this specific ES example, the market establishes a 30-minute high. In the second hour of trading, the ES breaks above that high with a strong, impulsive structural shift. It pushes 5 or 6 points higher, then begins to retrace.
And the precision of that retracement is what makes the retest so powerful. The ES pulls back, and the wicks of the 5-minute pullback candles tick down and literally kiss the exact price level of the 30-minute opening range high.
They tap the line, the algorithms instantly recognize the previous resistance as a new high-value support zone, they deploy massive buy orders, and the market aggressively rips higher off that exact touch.
Getting in on that kiss, identifying the successful retest, is how you dramatically increase your win rate.
And the mechanics apply symmetrically to the short side, though often with much more velocity. Take the NVIDIA example from the material.
Let's do it. We're looking at a tighter 5-minute chart for NVIDIA.
NVIDIA is a high beta, incredibly volatile asset. On this day, NVIDIA opens with a slight gap up, but it immediately encounters aggressive selling pressure. It completely fails to break the pre-market high levels.
The sources note the interaction with VWAP here, the volume-weighted average price. VWAP is arguably the most important intraday institutional anchor.
It represents the average price a stock has traded at throughout the day, based on both volume and price.
In the NVIDIA example, the price attempts to push above VWAP, trying to establish a bullish posture, but it is violently rejected, closing a 5-minute candle heavily back below the VWAP line.
That rejection is a glaring signal that the localized intraday bias has shifted heavily bearish. Institutional sellers are defending the average price.
That rejection sets the context. The 5-minute opening range on this specific day was exceptionally tight, forming between $108.95 and $109.41.
A tight range is a coiled spring. It implies massive energy buildup with no directional release yet.
When the price finally flushed through the floor of that range at 108.95, confirming the breakdown away from VWAP, it didn't slowly drift lower. It triggered a cascading, straightforward, algorithmic sell-off.
The trader who patiently waited for the breakdown of that tight range, aligned with the VWAP rejection, caught an immediate and aggressive move to the downside.
And, it's not just equities or index futures. Let's pivot to crypto and commodities for a second, because ORB isn't just for stocks. The same mechanics apply to, say, Bitcoin or gold.
Oh, absolutely. Bitcoin is fascinating because it trades 24/7, but the U.S. equity open at 9:30 still creates a massive volatility injection.
Right, because all the EPFs open and traditional finance starts moving capital. So you can draw an opening range for BTC just based on that 9:30 volume spike.
Exactly. You might see Bitcoin consolidating overnight, right around, let's say, 65,000, 9:30 hits, and it violently spikes to 65,500, then drops to 64,800. That's your new opening range for the U.S. session.
And the fakeouts are brutal in crypto. I've seen BTC break the top of that 9:30 range, trigger a massive wave of retail longs, and then instantly reverse and duke 1,000 points because the institutions were just hunting liquidity.
That is why the retest rule is even more critical in crypto. You have to wait to see if the previous resistance actually holds as support or if it was just a liquidity grab.
And gold is similar, right? Except gold operates heavily around the COMEX open and the London overlap.
Yeah, gold is incredibly sensitive to the 8:30 a.m. macro data drops like CPI or jobs data, and then the 9:30 equity open.
So picture the gold chart. You've got your XAU USD ticker up, data drops at 8:30, gold shoots up and forms a massive range. You wait for the 9:30 open to see if the equities market agrees with that directional bias.
If gold breaks out of that initial morning range and successfully retests the boundary, it's often the start of a massive trend day. If it fails the retest, it's a massive trap.
Okay, so we have the framework. We understand the statistical edge of the open. We filter stocks in play with massive relative volume and catalysts. We establish a contextual directional bias. We draw the boundaries of the chop zone. We demand a full body breakout with expanding volume, and we wait for the mechanical retest to confirm previous resistance as new support.
It sounds incredibly systematic.
It sounds like a license to print money if you just follow the steps.
And that exact assumption that a perfect setup guarantees a positive outcome is the psychological trap that liquidates most day traders. The market guarantees absolutely nothing.
Right.
You can have a flawlessly executed ORB setup, a beautiful retest, volume confirmation, and the very next tick, a macroeconomic headline crosses the wire and the asset plummets 50 points against you.
The reality is that the only difference between gambling and professional trading is the strict mathematical control of what happens when the trade fails. We have to dive into the math of survival here, risk management and stop-loss placement.
Because if you enter on that Apple retest at 175.50, and instead of bouncing, the price just slices right back down through the line and re-enters the chop zone, you are in immediate danger.
The sources outline two distinct philosophies for managing that risk on an ORB trade. The first is the aggressive stop-loss approach. In this model, the trader places their hard stop just below the low of the specific candle that broke out of the range.
The logic is tight invalidation. If that single confirmation candle was a lie, and the buyers immediately lose control of that localized structure, the trader cuts the cord immediately.
The benefit there is your capital risk per trade is very small. You're taking a tiny paper cut. But the obvious drawback is that you are subjecting yourself to the localized volatility of the tape.
Yeah, a random momentary algorithm sweep could spike the price down, trigger your tight stop loss, and then immediately reverse and run to your profit target without you.
Which leads to the second, conservative approach, placing the stop loss completely outside the opposite side of the opening range. If you are taking a long breakout above the 15-minute high, your stop loss goes all the way down below the 15-minute low.
That gives the trade a massive runway to breathe. The stock can chop around, dip back into the range, test different moving averages, and you are still safe as long as the fundamental structure of the opening range holds.
But the math on that is brutal. If the stock does break the low and hits your stop, that is a massive account-damaging financial loss to absorb. Your risk on the trade is the entire width of the daily range so far.
But regardless of whether you choose the aggressive candle stop or the conservative range stop, the masterclass sources agree on one absolute unbreakable golden rule.
What's up?
If the price fully reclaims the breakout level, meaning it breaks out, you buy the retest, but it fails to hold support and decisively closes a 5 or 15-minute candle back inside the opening range chop zone, you must manually exit the trade immediately, regardless of where your hard stop is placed.
The mechanics of why that rule exists are vital. When a stock breaks out of a well-defined opening range, you are not the only one buying. Thousands of retail traders, momentum algorithms, and institutional flow are all buying that exact same technical line.
You are part of a massive collective long position.
If that breakout fails and the price falls back into the chop zone, every single one of those buyers is suddenly underwater. They are trapped.
And trapped traders represent future selling pressure. As the price bleeds lower into the range, panic sets in. When that collective mass of trapped longs finally capitulates and hits the sell button to cut their losses, they flood the market with sell orders,
Causing the price to plummet aggressively.
Fine.
You don't want to hold a long position while thousands of trapped traders are desperately trying to liquidate. You take the small loss the moment the structural thesis is invalidated.
This entire discussion of risk and reward leads directly into what was arguably the most illuminating part of the source material.
Oh, the backtesting experiment. We have to talk about this. We looked at an experiment conducted by a prominent quantitative YouTube channel, Trading Stocks. They wanted to move past the theoretical and actually put the ORB strategy through a hard-coded algorithmic stress test.
The premise of the experiment was stress testing an incredibly popular ORB variation touted by an Instagram trading influencer.
The influencer's rules were aggressively simple. On the S&P 500 futures, mark the high and low of the 15-minute pre-market candle from 8 a.m. to 8:15 a.m. Wait for the 9:30 a.m. open. If the price breaks the high of that pre-market range, buy the retest of the midpoint of that 8:15 candle.
The setup itself isn't terrible, but the risk parameters the influencer promised were highly suspect. The strategy claimed a 4-to-1 reward-to-risk ratio.
The rule was, set a hard profit target at 20 points and use an incredibly tight 5-point stop loss. So you are risking $5 to make 20. Mathematically, it sounds like an infinite money glitch. You only need to win 25% of your trades to break even.
And when the YouTuber initially coded this logic into the Thinkorswim platform to run an automated backtest across historical data, the initial equity curve was a straight lineup. It looked like the holy grail of trading strategies.
But a deeper dive into the code revealed a massive limitation in how basic backtesting software processes intrabar data. The code was cheating.
This is a crucial concept for anyone trying to automate or backtest their own strategies. If you are looking at a 15-minute candle, that candle represents 15 minutes of chaotic, bidirectional price action.
Right, the price might swing up 25 points, then crash down 10 points, and finally close somewhere in the middle. But the basic backtesting script was reading the data top-down. It saw that the high of the candle hit the 20-point profit target, so it immediately recorded a massive win.
Exactly. The look-ahead bias completely ignored the chronological path of the price action. It ignored the fact that early in that 15-minute window, the price first dropped 10 points, which would have absolutely triggered the tight 5-point hard stop loss in a live market environment.
The computer simulation essentially said, we hit the profit target eventually, so the trade was a success, completely ignoring the reality that the trader would have been forcibly liquidated and kicked out of the position minutes before the profit was ever realized.
So the coder recognized the flaw. He had to go into the script and force the program to prioritize risk. He added logic stating that if the price touched the 5-point stop-loss level at any microsecond before reaching the 20-point profit target, the trade had to be recorded as a total loss.
He injected the reality of live market mechanics into the code.
And the moment that reality check was applied, the influencer's 4-to-1 strategy imploded. The equity curve collapsed into deep red territory. The win rate plummeted to single digits.
The fundamental issue became glaringly obvious. A 5-point stop loss on the S&P 500 futures at the 9:30 a.m. open is statistical suicide. The natural chaotic noise of the opening bell, the standard deviation of the diddle rhythm was constantly triggering the tight stop before the actual directional move could even begin to materialize.
The stop loss was so tight it was treating normal market breathing as a structural failure. But this is where the coding experiment pivots from debunking a myth to actually discovering an edge.
The coder didn't scrap the strategy. He decided to completely invert the mathematics. He flipped the risk-reward ratio upside down.
He changed the parameters to a 1-to-4 reward-to-risk ratio. He set a very conservative profit target of just 5 points, but he massively widened the stop loss to 20 points down. He was risking $20 to make 5.
Now, I have to push back here because if you read any traditional trading textbook, any risk management manual, risking 4 units to make 1 unit is considered heresy. It goes against everything taught in fundamental risk management.
And we absolutely need to contextualize these backtest results with real-world trading mechanics because taking this data at face value is dangerous.
Right.
In the sterile environment of the backtest, this inverted 1-to-4 strategy was a massive success. The win rate skyrocketed to an astonishing 75%. Over a simulated 180 trading days, trading massive size, the strategy generated over $1 million in simulated profit.
The math makes sense on a spreadsheet. Because the stop loss was 20 points wide, it was effectively placed completely outside the noise of the opening volatility. The trade almost never got stopped out by random algorithmic sweeps. It had massive room to breathe.
And because the profit target was only 5 points, it was an incredibly easy threshold for the momentum to cross.
The sheer frequency of the wins, the 75% win rate, mathematically overpowered the size of the rare 20-point losses. The average simulated loss was $42,000, while the average win was only $25,000. But the wins happened so often that the net equity grew.
But here is the reality check, the massive caveat to that data. While it proves that high win rate systems can mathematically overcome inverted risk-reward ratios on paper, executing a 1-to-4 risk strategy in live, leveraged futures markets is a psychological and mechanical nightmare.
The backtest assumes perfect liquidity and perfect execution. It doesn't account for extreme slippage.
Right. If you have a 20-point stop loss and the Federal Reserve suddenly releases an unexpected statement or a massive algorithmic sell program triggers a flash crash, the market doesn't smoothly trade down to your 20-point stop and politely take you out.
The liquidity instantly vanishes. The bid-ask spread widens from 1 tick to 20 ticks.
Your 20-point stop order might get filled 40 or 50 points lower due to massive slippage. When you are already risking 4 times your potential reward, a slippage event of that magnitude will cause catastrophic, unrecoverable damage to your account.
You cannot absorb black swan events with an inverted risk profile. The takeaway from the backtest shouldn't be start risking 20 points to make 5.
No, the true value of the experiment is understanding the relationship between the width of the stop loss and the win rate. It proves that blindly copying an arbitrary 4-to-1 risk-reward ratio from social media is guaranteed to fail if it doesn't account for the localized volatility of the asset.
You have to size your risk based on the asset's specific behavior, not an arbitrary dollar amount.
Okay.
Which leads us to the final piece of the quantitative puzzle. The coder wanted to adapt this ORB logic from the highly leveraged futures market over to standard equities.
But you can't just hard-code a 5-point profit target on a stock.
Because like a 5-point move on a $10 penny stock is a massive 50% intraday swing, which is incredibly rare. But a 5-point move on a $500 stock like Meta or Netflix is a 1% fluctuation that happens in the first 3 minutes. The math doesn't translate.
You need a dynamic stabilizer. You need a way to normalize the math so the risk parameters automatically adjust to the unique volatility footprint of whatever chart you are looking at. And the source material highlights a perfect indicator for this, the ATR, or average true range.
The ATR is a beautiful piece of math. It measures the average distance from the high to the low of the previous 14 candles. It quantifies the current localized volatility of the specific asset.
Yeah, I always describe it as measuring the stock's personalized breathing rate.
A highly volatile, low-float tech stock takes massive, deep breaths. Its ATR is huge. A stable, large-cap utility stock takes shallow, little breaths. Its ATR is tiny. The indicator constantly calculates the size of the average breath.
By tying your risk parameters to the ATR, you remove the arbitrary guesswork. To normalize the strategy for stocks, the coder utilized multiples of the ATR. He set the profit target at exactly 1 times the current ATR value and placed the stop loss at 4 times the ATR value.
So if a stock was moving erratically with wide swings, the ATR expanded, which automatically widened the stop loss to prevent the trader from getting chopped out by the noise, while simultaneously pushing the profit target higher to capture the expanded range.
And if the stock was moving slowly, the ATR contracted, tightening the parameters. The strategy dynamically adapted to the environment.
It's an incredibly robust way to approach system design. So let's take a step back and look at what we've assembled. We have the historical data from the 1960s and the Grimes study proving the opening print is statistically significant.
We have the strict filtering criteria, finding stocks in play with massive relative volume and a defined catalyst.
We understand the mechanics of drawing the chop zone and establishing a contextual directional bias. We know to wait for the full body breakout, accompanied by volume, and to execute on the retest of the boundary to avoid algorithmic traps.
And we have a dynamic ATR-based framework for managing our risk and setting profit targets. The system is complete, it is mathematically sound.
And yet, with all of that objective logic perfectly aligned, the vast majority of day traders attempting to execute this strategy will still consistently lose capital.
The system is flawless on paper, but the execution relies on the most unpredictable, erratic variable in the entire equation.
Human psychology.
Exactly. The math is completely irrelevant if the trader cannot control their own mind.
The mental game. Because all the ATR calculations in the world won't save you if your heart rate spikes, your adrenaline surges, your finger starts twitching, and you impulsively click buy 5 minutes before the setup is actually confirmed.
The psychological warfare of the market open is intense. One of the hardest cognitive biases for a new trader to overcome is the sheer, overwhelming FOMO, the fear of missing out that hits the exact second the 9:30 a.m. bell rings.
You've been preparing for an hour. You've built your watch list. You've drawn your levels. The bell rings, the volume explodes, the level 2 data starts flashing like a strobe light, and you see a massive green candle rocketing upward on your chosen stock.
The neurochemistry of that moment is working entirely against you. Your brain sees that green candle and registers it as immediate fleeing opportunity.
The dopamine hit is directly tied to the action of being in the trade. You aren't analyzing structure anymore, you're reacting to flashing lights. You just want to be on the ride before it leaves the station.
Which is why one of our key sources, veteran trader Stacy Burke, advocates for a completely contrarian philosophy regarding the market open. He operates on a framework he calls the 10 a.m. Club, focusing his execution entirely on the third hour of the trading day.
Burke breaks the morning down into distinct psychological phases. From 8 a.m. to 9 a.m. is the pre-market positioning. 9:30 a.m. is the New York Open. The period from 9:30 to 10 a.m. is the initial chaotic flurry, the dam breaking.
But 10 a.m. onward represents the third hour. This is where the dust settles.
The philosophy behind the 10 a.m. Club is profound in its discipline. The core mandate is, let the market show its hand. Don't try to guess the outcome of the opening algorithmic coin toss.
Let the high-frequency trading firms, the market makers, and the massive institutional block orders fight it out for the first 30 minutes. Let them absorb all the pent-up overnight liquidity.
Let them establish the absolute high, let them establish the low, and let them commit vast amounts of capital to a specific direction. Only after the dominant trend is firmly established do you look to enter.
There is a fantastic quote in the source material from trading author Philip Schutz that perfectly encapsulates this. He writes, "If most traders would learn to sit on their hands, they would make a lot more money."
It sounds almost insulting in its simplicity, but it's the hardest thing to do.
Yeah.
Sit on your hands. Literally, physically, place your hands under your legs until the clock strikes 10 a.m. Letting the market set up the structure before you deploy your capital is the ultimate expression of trading discipline.
Because the patience to wait until 10 a.m. often reveals the traps that destroy the impatient traders. We have to discuss the concept of higher time frame walls because this is where a hyper-focused, zoomed-in perspective becomes deadly.
You can have a flawlessly textbook 5-minute opening range breakout. The price clears the high boundary. The volume indicator spikes beautifully. The pullback retests the line perfectly. The 5-minute chart is screaming at you to buy.
But if you take your eyes off the 5-minute chart and you zoom out to a daily or weekly chart, you realize your beautiful 5-minute breakout is steering your trade straight into a massive book wall.
Precisely. If that 5-minute breakout is driving the price directly into a major higher time frame resistance level, let's say a weekly 21 EMA, or a massive multi-month supply zone where institutional sellers have historically defended their positions,
that higher time frame level is going to act like a black hole. It possesses immensely more gravitational pull than your 5-minute ORB setup.
the higher time frame sellers will completely absorb the localized buying pressure of the breakout, instantly halt the momentum, and forcefully reject the price back down, completely destroying your strategy.
I love the analogy of looking through a microscope. You are so intensely focused on the microscopic movements of the 5-minute candles, marveling at the perfect little retest, that you are completely oblivious to the macroeconomic freight train barreling down the tracks right at you.
The context of the macro environment supersedes the localized setup.
Which is exactly why Burke emphasizes that false breaks at these key higher time frame levels are frequently the genesis of the largest, most profitable moves of the entire day.
If you have the discipline to sit on your hands until 10 a.m., and you watch the market attempt a 5-minute breakout, hit that daily resistance wall, and aggressively fail, That resulting reversal offers an incredible asymmetrical risk to reward opportunity.
You are essentially piggybacking on the institutional rejection. You are actively trapping all the impatient retail traders who bought the high, using their inevitable stop losses as fuel for your short trade.
It all circles back to mastering what the masterclass sources continually refer to as your state of mind. We have an incredible foundational quote here from the legendary trading psychologist Mark Douglas.
In his analysis of trader behavior, he states, "The consistency you seek is in your mind, not in the markets."
That single sentence might be the most crucial takeaway from all of our research today. The fundamental error amateur traders make is attempting to extract consistency from an environment that is inherently inconsistent.
The market is not a math equation with a fixed answer. The market is an endless, fluid stream of shifting variables, unknown participants, and hidden algorithms.
The market is what Burke vividly describes as the diddle rhythm, the constant random microfluctuations of price ticks bumping up and down, specifically designed to emotionally yank you around.
You see a green tick, your brain registers greed, and you want to buy. You see a red tick, your brain registers fear, and you want to sell. You are a puppet being pulled by the tape.
To execute the ORB strategy, or any trading system, successfully, a trader has to cultivate a cognitive state that is completely immune to that diddle rhythm. You must decouple your emotional state from the outcome of any individual trade.
You define your opening range based on the data. You define your directional bias based on the catalyst and relative volume. You define your risk parameters mathematically, perhaps using the ATR. And then you simply wait for those specific criteria to be met in reality.
If the criteria are met, you execute the trade without hesitation. If the criteria are not met, or if the price remains trapped in the chop zone, you do absolutely nothing. The decision-making process is entirely binary in your mind, regardless of how chaotic and violent the market itself appears on the screen.
It requires an acceptance of probability. You have to truly internalize that any single trade is essentially random, but a series of trades executed flawlessly according to a statistically proven system will yield a positive outcome over time. That is the essence of professional trading.
So to synthesize our deep dive mission today, the opening range breakout is not a myth, nor is it a guaranteed shortcut. It is a historically backed, statistically powerful strategy that requires a rigorous, systematic approach.
You must filter out the noise and find true stocks in play, driven by massive relative volume and clear fundamental catalysts.
You must establish a logical directional bias based on pre-market context, not just lagging indicators. You must respect the boundaries of the chop zone, wait patiently for a full-body breakout confirmed by volume, and crucially, execute your entry on the retest to avoid the algorithmic fakeouts.
And you must defend your capital mathematically. You utilize tools like the average true range to dynamically adapt your profit targets and stop losses to the localized volatility of the asset.
You must rigorously backtest your assumptions, understanding that the most appealing risk-reward ratios on paper can be the most dangerous in a live market environment filled with slippage and widespreads.
And perhaps the most difficult requirement of all, you have to develop the iron discipline to physically sit on your hands until the market clearly shows its hand.
You have to conquer the adrenaline of the 9:30 a.m. bell, ignore the diddle rhythm, and wait for the true institutional structure to form. It is a phenomenal, delicate blend of quantitative statistical probability and rigorous human psychology.
It's the ultimate test of systematic execution in an environment of total freedom.
So what about you? Yes, you listening. Have you ever attempted to trade the opening range breakout in a live market? Did you find yourself getting completely chopped up in the algorithmic meat grinder of the first 15 minutes, trapped in false breakouts?
Or have you found a specific sweet spot, a unique time frame combination, a specific ATR risk metric, or a sector focus that actually generates consistent results for you? We want to hear the mechanical realities you've experienced with this strategy in your own journey.
And as we close this analysis, this raises an important overarching question for you to ponder. If the statistical significance of the opening range is this well documented, stretching all the way back to Arthur Merrill in the 1960s, and if automated backtesting scripts can now dynamically optimize the exact ATR risk ratios for success in milliseconds.
How long until the massive institutional algorithms completely price out the retail trader's edge in those first 30 minutes? Or is the sheer raw chaos of human emotion at the opening bell, the panic, the greed, the FOMO, the one final variable that algorithms can never fully predict or control?
That is a fascinating thought to leave on, the battle between the machines and human psychology. Keep analyzing those charts. Stay ruthlessly disciplined with your risk management. Stay curious, keep learning, and we will see you when we dive deep into our next topic.